Hey there, everyone. Hope everything's going well for you. Um, I'm taking some time today to do some videos on some information that might be useful to you, especially since we can't have our annual farmer meetings that we usually have with dinner. And hope you're all healthy and hope you've been able to stay healthy over winter. And if you have encountered the COVID thing, hope that you healed up just fine out of it. So, with that, today I'm going to be talking about several different yield options that are available for you to look at on your policy. Some are automatic and some have to be elected. A lot of you have elected to do a lot of these options on your policy. Some of you maybe looked at them when they first came out and chose not to do them at that time and maybe want to relook at them this time. Please be sure uh, to ask us about them if you have any questions when we do meet with you individually during February and March. So with that, I am, bear with me because I'm still trying to get the hang of this video thing. And right now I'm gonna go through my presentation on the different yield options. And please be sure to ask us if you have any questions about how they work. So with that, I'm going to start my presentation. All righty, so here we go. Title of my presentation is the options that you can use to increase your approved APH yield. For those of you that don't know what APH is, we tend to use a lot of acronyms in crop insurance just because sometimes there are just so many words, but APH is actual production history. So it is your history with all your actual yields in it. All right. The first thing I'm going to talk about is what is new for 2021, and that is the quality loss option. It's new for 2021, and it applies to all post-quality adjustments. That includes falling numbers, test weight, grading issues, defects, and the like. There might be other things that aren't listed here that might have caused a quality adjustment to your policy, to your production that's in your policy. It applies to any year in your database that has a notice of loss filed. So you had to have a claim submitted, and then they actually took quality loss adjustment on your production. You do not have to actually have a loss paid on that, but if they are using post quality loss production, and you did file a notice of loss that year, this would apply to you as well. It will apply to prior years in your database as long as you or I have the supporting documentation to back up that the quality loss was taken that year. It's available for barley, buckwheat, canola, corn, flax, oats, rye, soybeans, sunflowers, and wheat. It's not available for any crops that do have the CAT coverage. You can opt out of the quality loss option on a qualifying year within the database as long as you do that by the production reporting date, which is April 29th for your spring crops. One option, yield adjustment option or yield option on your policy is automatic, and it's called the yield cup. It's an option on the policy that prevents your current approved APH yield from being less than 90% of your previous year's approved APH yield. So an example to that might be, let's say in 2020, your approved APH yield was 100 and you had one awful 2020. And now you plug in that 2020 yield, and your average yield when calculating it out actually comes to 88. Well, 88 is below 90% of last year's average yield. So 90% of last year's average yield is 90. So you will actually get to use the 90 for your approved APH yield for 2021 rather than having to use the 88. It may apply if you have yield substitutions of YA in your policy. When yields are excluded under the YE election, and when yields are replaced under the quality loss option. When your prior year's approved APH yield was a yield floor, it will also apply as long as your current year's approved APH yield is lower, more than 10%, or is within 10% less than last year's yield floor. They do not apply when there is no prior approved yield. You don't want to really take 90% of zero. And they will not apply when more than 1 year's production is added to an APH database. And when non-actual yields are replaced with adjusted T yields, or when your previously approved APH yields are corrected or changed, then the yield cup will not apply from last year to this year's. And also, if you opt out of the cup applying, of course, it's not going to apply. So the yield floor is also an automatic yield adjustment option on your policy. Unless you have some other options, then it may not apply. But if you had no other options added to your policy, the yield floor would apply. And yield floors are yield limitations designed to mitigate the effects of catastrophic years on your approved APH yields. That would be like, let's say you have 10 years of history in there, and we had an awful spell of drought years in there. So you have like 4 or 5 years that just are just horrible in your database. The yield floor comes in to protect your approved APH yield. What they do is they apply the yield floor to your APH database, and only APH databases with at least one actual or assigned yield, and those ones are eligible for the yield floor. Yield floors are applicable to additional coverage policies. So it has to be a non-cat policy or non-cat crop. And it's available for both new and carryover insureds. When applicable, the approved yield will not fall below the yield floor. So the yield floor is a percentage of the applicable county T yield. Now, your county T yield is a yield that is put in place by the risk management agency that is given to a county crop for those that don't have the full 4 or plus years of actual history. The county T yield and a percentage of county T yield can be applied into that database. But the yield floor is a percentage of the county T yield and is based on the number of years of records provided by you, the policyholder, for the crop in the county. So how do you determine what you get? So the base option is 80%. But if you only have 1 year of actual history for that crop, the yield floor will be 70% of the county T yield. If you have 2 to 4 years of actual yields for that crop, then the yield floor is 75% of the county T yield. And once you have 5 or more years of actual history in that crop, then you get the full 80% of the county yield as your yield floor. So what does that mean? With those years, let's, in my example of, horrible drought, you have 4 or 5 years that are just bringing down your history or your average yield. And now you're below 80%, your average yield is below 80% of the county yield. They will actually floor it at 80% of the county yield, as long as you have no other yield options on your policy. Now, in some crops in some counties do have an option to buy up to the 90% of the yield floor or 100% yield floor. And based on the number of years of records determines what percent you will actually be able to use at those levels. Next, we're going to get into some yield limitations that you have to actually add to your policy. These are options that need to be added to your policy, and for the most part, they need to be added by the sales closing date, which for our spring crops around here is March 15th. First one we're going to go over is the yield adjustment. Most of you already have the yield adjustment to your policy. We made sure that just about everybody had it when it first came out many years ago. And what the yield adjustment does is it applies when an actual yield in your database falls below 60% of the county yield for that corresponding year. The yield adjustment option must be added to your county crop by the sales closing date, which we talked about, and that's March 15th for spring crops. So let's go back to that. So let's say in that example where I talked about that you had 5 years of horrible drought yields in there, and a lot of those years are below 60% of the county yield. What they will do is by adding the yield adjustment to your policy, it replaces those yields with 60% of the county yield. Now, I have some examples of how all this works later in the presentation. So we will go over all these different options and see how they apply to your policy. Next, we're going to talk about yield exclusion. The yield exclusion, along with the trend adjustment, were added probably about 5 years ago. And these have made drastic improvements to your approved average yields for several producers. So let's take a look at how the yield exclusion works. The yield exclusion, when it's elected, allows a producer to exclude yields from a certain crop year when the RMA, which is the Risk Management Agency, determines the county yield for a crop year was at least 50% below the county average. Now, a lot of times they do not determine a year that can be excluded until the following year. So like, let's say 2020 was an awful year. You're not going to be able to exclude 2020 until the 2022 crop year. They have to wait for all the data to come in to determine that the county yield average was below 50% of the county yield. So it'll take a year lag before it may show up, but there are other yield options that will help you if your yield is 50% below the county average. So you do need to elect the yield exclusion by the sales closing date, March 15th, and the election is made on a county crop basis. So you do it by crop, by county. You have until the production reporting date, which is April 29th for spring crops, to opt out of the yield exclusion for specific years from specific units. Now you may be asking yourself, why would you want to opt out of the yield exclusion? Well, I have seen where people actually have a pretty decent yield in their database, even though that year is eligible for the yield exclusion, and is actually much better for their history to opt out of the yield exclusion and actually include that year in their history. So if you do decide you want to opt out for a certain year, you need to make sure that we do that by the production reporting date, which is April 29th for your spring crops. Next, we're going to go into the trend adjustment. The trend adjustment, a trend adjusted APH, if elected, adjusts yields in your APH databases to reflect increases in yields through time in the county. Now, many of you know that something 10 years ago probably would yield a lot better now based on seed technology and farming practices than it did, 10 years ago. And now you're stuck with that yield in your history. Well, the trend adjustment, they are made on each eligible yield with a qualifying APH database based on the county's historical yield trend. The approved APH yield is calculated using the trend adjusted yields and any other applicable yields within the APH database. The trend adjustment has to be added to your policy by the sales closing date of March 15th for spring crops. And it's based on a county crop basis. So you may have different trend adjustments in different counties. Yield floors do not apply. So remember when I was talking about yield floors, sometimes when you add some of these options, they will not allow for a yield floor to apply when you're using the trend adjustment. Also, trend adjustments or yield adjustments, yield exclusions, yield cups, and quality loss option will all apply if they're elected with the trend adjustment. So to be eligible for the trend adjustment in a database, there must be at least one actual yield in the 4 most recent crop years. And if there's less than 4 actual yields in the 12 most recent crop years, then a reduced trend adjustment is used. So here we go. If you have 1 actual yield in the last 12 years, you only get to use 25% of the trend adjustment with that actual yield. If you have 2 actual yields, then you get to use 50% of the trend adjustment added to those 2 actual yields. And as you see for 3 and 4, 3 years is 75%. And once you have 4 or more actual yields, you get to the full effects of the trend adjustment for your actual yields that you have in there. The trend adjustment is applied to each eligible yield in a qualifying APH database and will be adjusted upward by the trend adjustment multiplied by the age of the eligible yield. The age of the eligible yield is determined by subtracting the yield year from the current crop year. So, as an example, the crop year is 2021. The trend adjustment is 2, and that's listed in the actuarial documents. The insured has eligible yields in 2020, 2021, 2020, 2019, 2018, and 2017 crop years. So below are the trend adjustments to be applied for each specific yield year. In 2020, we're 1 year past behind 2021, so you're going to take 1 times the 2 bushel trend adjustment, which is 2, and you're going to add 2 bushels to the 2020 actual yield that you have. In 2019, you're 2 years beyond 2021. And so you're going to take 2 times 2 bushels, which is 4, and add 4 bushels to the actual yield for 2019. And so it goes for 18 and 17. You'll take 3 and 4 times the 2 bushels and add the 6 and the 8 bushels to the actual yields for that year. So let's do some comparisons here on how all these options work on your policy. First, we'll start with a producer who has 10 years of history. He has in 2011, total wipeout, nothing. 2012 through 2016 were good, some really good, some mediocre years. 2017, another wipeout. 2018, it's okay. 2019, we've got not so good year, but we did harvest something. In 2020, oh, total wipeout, hailstorm, wiped it all up. So if you had no yield options added to your policy, you would take all 10 years, add them up together, divide by 10, and you would have an 84 bushel average. Now, without any extra options, you'll see that you would have the yield floor apply. The yield floor, if you remember, is 80% times the current county yield, which was 110. So 80% times 110 is 88. So in this case, you would have a yield floor, an approved yield of 88 bushel per acre. Now let's see if you add the yield adjustment to your policy. If you remember, the yield adjustment replaces any yields, actual yields that are less than 60% of the county yield. So in 2011, had a 0. So obviously that's going to get replaced with 60% of the county yield for that year, which is 60% of 97 is 58. Then we get our good years in there. Then we have that big old fat 0 again for 2017. And so 60% of the county yield is 105 in 2017. 60% of that is 63. So we will replace it with 63. We have a 63 in 2018. Now the yield changes in 19 and in 20, we have 110 for the yield, but 39 is not so good and neither is that big fat 0. So we're going to replace them with 60% of the county yield, which will be a 66. So now our new approved yield is going to be 105. We would take all those replaced yields, add them up with the actual yields, divide it by 10, and we have 105. So just by adding the yield adjustment to your policy, look at what you go from an 88 to 105 for an average. That's a pretty good increase for you. Okay, now let's see what happens if we add the yield exclusion. Now, remember the yield exclusion are, you can exclude the years, the yields from the years that RMA determines that the county average was below 50%. So the yield exclusion is available for the years 2011, 2017, and 2020. So now we're going to exclude 2011. We're going to exclude that big fat 0. We're going to exclude it in 2017, and then we're going to exclude it in 2020. By excluding those years, we take them out, don't use them in our average. So now we're going to add all the other years up, and we come up, add these all together, divide it by 7, you come up with 123 for an average, just by excluding those 3 years with horrible yields in them. Now, let's say we add the trend adjustment with the yield exclusion. Not the yield exclusion, the trend adjustment and the yield adjustment. Okay, so we got to look back here. Now we're going to have the yield adjustment of 58, but we're going to add 10 years of the 2.6 trend adjustment to it. So you're going to take your 58 plus the 26, which is 10 times 2.6, and have an 84. Okay, then we're going to Do the same thing with all the other ones. And then all the way through, we've added the trend adjustment to all of them based on how old the yield is. And we come to a 119 for an average. Now, in this case, you're probably thinking, well, why would I do the trend adjustment? Well, let's look one step further and actually add the trend adjustment, the yield adjustment, and the yield exclusion and see what that does. So we're going to, even though by using the trend adjustment and the yield adjustment, we had an 84 instead of a 0, we might be better off just totally eliminate that yield. Let's take them out. They still are kind of mediocre yields that we don't need in our history. So we take them out and we add the yields together, the 7 years, and here we get 138. Look at that difference, 138 versus an 88, 50 bushel difference, an 88 with the yield floor. Look at how these help your average yield. And you got to remember that your average yield is the basis of your coverage. It determines how quickly your loss will kick in. So now we're going to add the quality loss, and I'm just going to show you just the quality loss without any extra options on there, just to show you how that works. Now, in this case, the only year that he had a qualifying loss was in 2019. So his quality loss production, pre-quality loss production, was 96. But after all the discounts came out to 39. Well, they used the 39 because that's what he got paid on. But without it, without the quality affecting his yield, he actually had a 96. So you see, by plugging in the 96 and leaving all the other yields the same, he would have an 89 for an average versus the 88 with the yield floor. Well, ideally, a lot of these options work together to help build it up. So now we're going to add all 4 of those options together and put them on the policy. We're going to have the yield exclusion for 2011, not going to use that yield. We're going to have the TA working on 12, 13, 14, 15, and 16. Exclude that 2017 FAT 0. In 2018, we put the trend adjustment on. And then in 2019, we have the quality loss plus the trend adjustment. So that brings it up even more. So look at that, a 143 average by adding all 4 of those options on. Now, adding options on, there aren't any specific rates for each option. Each option, the more that your options increase this yield here, and make and the bigger the difference between what your approved yield is with all the options and what your actual yield is determines how expensive it's going to be. So the greater the distance between your approved yield and what your actual yield is determines how expensive it's going to be. Now, you may want to look at this and then maybe consider even dropping your yield, not your yield, but your coverage down. The subsidy factors change in certain levels. Like there's a big difference between the 70 and 75% when it comes to subsidy. So if you're currently at the 75% and you chose to add some of these yield options, you would be sometimes surprised that you could actually guarantee yourself more and it would cost you less. If you say sometimes what I've seen is that, let's say in this case, you added the quality loss option and it brings your yield up to a 143, but you had the trend adjustment, yield adjustment, and yield exclusion, and you were at 138. Sometimes if you look, at 75%, 138 with those options might cost you more than 70% with the 143 option, with all those options. It's definitely something you need to look at. And the biggest reason is, when the trend adjustment and yield exclusion came out a number of years ago, several people, it actually was more beneficial and cheaper for them to go to the level below what they normally have in order to get a higher subsidy. And it just doesn't seem logical, but when you're not dealing with the same subsidy at different levels, it does make it it does make it a little more attractive to go to those lower levels and actually have better coverage for less money. So definitely something you need to look at. So with that, I hope you learned something today. And if you have any questions as to what options would work best for you, please be sure to ask us when we meet with you. We are definitely looking forward to helping you out again for the 2021 crop year. And as always, thank you for continuing to trust us with your crop insurance needs. And if you have any questions, please give us a call. Thanks a lot.